we'll get straight to individual names and stocks. What do we have? Opening bell on your screens now. We have the Nifty, which is at 25,313. You've got the Sensex, which is at 79,682. So it's a good start. 0.75% higher on both the Nifty and the Sensex. Bank Nifty is up about 0.8. 50,120. 50,120 is where the Nifty Bank is at. The IT index is up about 1.25%. 1.5 now, 40,300. So that's doing very well. And look at the market breadth. Almost 3:1, actually more than 3:1 in favor of advances. So are we approaching the 200-point bump up for the Nifty? We are 192 in the first initial couple of seconds of market open. But let's get to stocks. Survi.
Absolutely. I'm just looking at broad, sectoral trends. You've got the metal index, the IT index, even PSUs, oil and gas. Lots of green pretty much across the board today. And since it's a global rally, metals are right up ahead. Hindalco 2.5% on the upside. Tata Steel 1.5% up. There's JSW Steel pushing about a 1% gain. So all of the metal stocks doing well. On the commodity side, ONGC is having another good run, 2% higher. M&M, the response to the new 5-door Thar is all green. 2.5% up on that stock. Then IT is the other strong pillar for the market. Tech Mahindra, LTI, Mindtree. These are stocks on the positive side. Among the biggies, there's also TCS, of course, which is supporting the market. Among the banking biggies, HDFC Bank, ICICI Bank on the green side, gains about 1% on those stocks, supporting the market. Bharti Airtel up about 1% as well. Rima was just talking about that stock. Actually, on the Nifty, there are only 2 stocks on the way down. Actually, one. HDFC Life is about 1.5% lower. Apart from that, everything else is turning positive, including a power grid, which is at the flat line. So it's a very, very positive start and very, very well-rounded. I just want to look at Ola Electric as we move ahead. Yeah, 8.5%, 120. HSBC has called for a target of 140. The stock is already at 120. It's an electrifying start for this one. And Nigel, the company that you were talking about, RHI Magnesita, 7.5% up over there.
Well, that's right. RHI Magnesita, I said those numbers were good and they were very good. And it's come after a few quarters. So that's why the street likes that. Stock up close to around 8%. Volume's not very, very high, though. Sequence Scientific, I think they as well came out with that set of numbers. And that's why that stock is up close to around 8.5%. The street seems to be liking those numbers. First Source, well, we've seen measures in the last 1 year or so. They've got a new CEO on board. His past record has been with Infosys as well as Tech Mahindra. They've gone ahead and upped their guidance as well. So First Source as well, that one is flying away with a gain of close to around 7% approximately. Remember, that one has been actually an underperformer, but now the street hopes that they'll get back to their growing base. So that's why that stock is up and about. Maupin Laboratories, they raised some money last week. The stock has been in this vicinity. This morning, we highlighted that metals could participate on the upside. And that seems to be the case. Most of these metal stocks are pulling back in today's trading session. Vedanta is the one that's going to be getting good amount of money from that OFS that they're doing in Hindustan Zinc. And because of that OFS that they've announced at a 15% discount, Hindustan Zinc is one of the top losers on the downside in terms of volumes. Ola Electric, take a look at that. It started off with a gain of 8%. Now it's up close to 16%. So the street likes the commentary coming in there and the new launches as well. So big up move is what we're seeing out there. HDFC Life, though, that's down close to 1%. I have some selling pressure out there. Glenmark Pharma as well posted its numbers. I think the commentary is something the street didn't like, so it's down close to 3.5%. And Max Financial, I recall it was down close to around 5-6% in Wednesday's trading session. Then the commentary was good on the margins going ahead. The stock recovered, but today it's giving back some part of what it put on, down close to around 2.5%. Prashant.
Okay, well, Ola is the big one, right? And it's got it's, by the way, the largest volume-led gainer across the board on the NSE. It's been that way. Sold stock at around 80 rupees. It's at 124, and it's traded only for about, 3 or 4 days now. And today may be the 4th session in its listed life. So that's an incredible run that we're seeing from Ola Electric. Okay, what else? Hindustan Zinc is the biggest. On the flip side, Hindustan Zinc is the biggest volume-led loser right now. Stocks at about 532. Glenmark is down 3%. You've got a Moil, which is down 1%. I spotted some of these life insurance companies, which are all lower. So Max Financial will come up on your screen, 2% down on Max Financial. And I think ICICI Pru is down 1.25%. HDFC Life is down 1.5%. So actually, life insurers as a pack is down at this point in time. And of course, this after, I think On Wednesday, you had the monthly numbers, which actually were pretty good across the board for life insurance companies, but stocks done well relative to the rest of the market recently. Back to tracking what is higher. Polyplex is up 6%. There is Capacite Infra, which is up 5%. Suprajit is up 7%. There are lots of these smaller mid-cap names, but they're all coming up with decent-sized volumes. Suprajit 7%. Moripun is up about 4%. Zaggle is up 5%. 369 on Zaggle. I think it did well last few sessions as well. 368, 369. Gabriel India is up 4%. High-Tech is up 4%. Powermesh is up about 4%. Inox India. Inox Green, of course, has been the big mover. But Inox India, the sort of specialty gas company, that one also is up about 5.5% right now. 1250 or so on Inox India. Zensar Tech, Madras Fertilizer, Uflex, I could go on. But volumes then, of course, start to trickle a little lower as they do at this point in the day. But it's a good-looking screen overall. Can't complain at all. 200 plus now on the Nifty, 24,350. Vineet Sambre is with us, Head of Equities at DSP Mutual Fund. Vineet, good to have you with us here. Thank you very much for your time. A small break in the upward trajectory is what we had. But to be sure, momentum started seriously flagging in many mid-caps and small caps, down 15, 20% very quickly. But what do you make of things now? The global scare, at least for now, seems to be behind us. You're kind of back to, the July kind of trading environment, more up and looking at what can go right rather than what can go wrong. So what does it mean for us here, Vineet?
So Prashant, good morning and thank you for having me on the show. So I think clearly, when we look at the Indian markets on the valuations, it's very clear that we are on a high range in terms of the valuations, and which is maybe the only risk. But as far as the fundamentals are concerned, we keep talking about the overall improving fundamentals. There could be blips in the interim, like we had this quarter which went by. We had seen some moderation, but there were reasons which we can talk about. But I think to your question, I would say that I think it is very volatile, as far as the environment is concerned globally. The news flows keep changing, and the views and the money which follows some of this news is huge. So one can change the views on a daily basis, but I would say that largely what we are thinking is as the US economy goes through cuts in the interest rate and it starts maybe recovering, that would give some kind of positive sentimental boost as far as the overall world markets are concerned. We are already trading at a high level. We should be careful. Should not sort of just maybe extrapolate the returns which one has seen over the last 2 to 3 years. Some kind of moderation we are seeing in the earnings, which is bringing some kind of caution in our minds as well from the valuations perspective.
Vineet, hi, good to have you on the show today. So I have to ask you about, I know you don't get into stock, but the theme of the day, right? Ola Electric, it's again brought a new company, a new business to the market, which has been loss-making, still is loss-making, but I think the market's willing to give it the benefit of doubt and trust the management, trust the market opportunity here. What are your own thoughts around EVs, the whole ecosystem? And I mean, if we get more listings here, a lot of the current OEMs, they're also expanding the EV portfolio, right? So what is your view around this? Would you be interested in more pure play, stand-up EV businesses?
So first of all, my congratulations to Bhavesh for a very great start on Ola. And I think the company, the stock is really pricing in the excitement around the EV proportion as it grows. But I think that as I understand, electric two-wheelers clearly will be will be the first beneficiaries of the electrification in the automobile segment, is what I feel. At the same time, I also believe that the jury is still out in terms of who will gain what kind of market shares eventually, because we already have the existing ICE players who are deep-pocketed, and they have also entered the fray. So maybe a lot of clarity will emerge over the next 3 to 4 years as to what kind of market shares these players will eventually have and who will eventually come out to be a big winner. The second important factor which you mentioned is about the profitability in the current environment. while we have seen that the volumes are growing, but still the company is yet to maybe come up to the levels of breaking even. So I think it is important to assess at what levels will the company break even, because eventually profits is going to be the driving factor for the valuations as we move forward. So I would say that currently what we have thought about is we are sort of looking at the neutral players which are really in the auto ang space, which are serving both the ICE as well as the electric vehicles, and just participate in the growth opportunity for the overall auto category as such. So I think that is how we would like to sort of play as of now, and maybe watch the space, see the companies, see the visibility of these companies breaking even, and then maybe take a big call on such names.
The issue price, just to remind everybody, was 76 rupees. Today's price is 122, so that's already a 60% pop for whoever got the allotment and whoever was willing to ride this one.
I'll tell you one more thing.
Yeah.
If you remember, there were all these reports which were suggesting that when the IPO was being sort of negotiations were going on, that Bhavish wanted to value the company at about $7 billion. I mean, that was I think there was an article or two as well. Finally, the IPO came at $4 billion, right? So there was obviously a lot of back and forth, etc. Guess what the market cap today is? 6.66.
He's almost there.
Almost $7 billion in 3 or 4 days. So,
that's what they say, right? You do your business, the market will give you a valuation.
Market will give you, and if you leave something on the table,
Yeah.
I mean, the market rewards you.
Yeah.
And I think you're right back there.
Okay, all right, interesting. Well, Vineet, good morning and always good to see you. Do you expect us to be bracing on the headline index for a bit of a time-wise correction? I think you were briefly alluded to that earlier. And I think the top sector that you believe that in terms of valuation comfort and how things are poised, I think it was the Nifty bank, the banking names. Is that still the top sector you like?
So, Nigel, I still feel that maybe we should see some kind of consolidation ahead as far as the markets are concerned. And really, what I was trying to allude towards the first quarter numbers which went by, we have seen some kind of moderation which has happened. Now, there are reasons which the corporates are assigning to maybe election quarter. We had all these freight issues which has hurt. So it will be important to maybe look at the quarters ahead if they are sort of recovering back, and which is going to be important factor and maybe the trigger for the markets to sustain the rally of the momentum. But I think till such time we should be in a range bound kind of a outlook for the markets. In terms of the segments, I think again a lot of these data points are coming out as these companies have announced the numbers, and I see that the trends in terms of the growth could change a bit from what we had seen in the past, and I would say that some of the segments which are linked to the low income household or the mid income household, they are showing some signs of recovery. And from that perspective, all these companies into two-wheelers, agri, consumers, consumer durables, I think these are the ones where incremental money could be allocated. While we all know the valuations are not very comfortable, but I think at least the money should get aligned to where we see recovery happening or the visibility or the growth sustaining as far as the businesses are concerned. And I would imagine that these are the ones where we see the growth trends sort of improving. On the banking front, Nigel, banking is the only sector which is maybe trading at valuations which are lower than the 5 years average. And from that perspective, it makes sense just from the valuation perspective. But I also feel that incrementally what is happening in the banking sector would also mean that there are lack of catalyst for them to see strong up move. And when I say that, what I mean is that the NIMs maybe are under pressure, the delinquency is incrementally sort of rising. So I think those trends will mean that the banking stocks, while they are cheap, they will require more catalyst for them to sort of see, up move.
Vineet, Pharma, what's your view? There are some news reports, and we'll sort of go into some details with this with our colleague Ekta, who tracks the space closely. But there are some news reports which suggest that under the Inflation Control Act in the US, starting January of 2026, prices for some of the top blockbuster drugs are being brought down dramatically. Now, of course, these are sort of patented drugs by innovator companies out there in the US. But there is some concern that down the value chain, could there be an impact on generic companies as well? I don't know if you've seen some of this, but just your thoughts.
So Prashant, I've not seen this particular news, but let me say that when most of these economies, or I think globally, the governments are interested in bringing down the overall healthcare cost, and which are generally very high, and especially in the US markets, because the patented products there, they start at a very high price points. But I think from that perspective, we stand slightly more beneficiary because we are supplying generic drugs to them. And basically, we are also sort of supporting their cause of maybe bringing down the cost of medicine, which I think Indian companies have great strength and they have proven themselves. And also, just coming out again from the first quarter commentaries from most of the management, I think most of them have spoken about the price decline getting arrested now as far as the generic molecules are concerned. So from that perspective, I would say that the US markets as such for our Indian companies today is standing on a good note, and maybe it sustains over the next 1 or 2 years or even years ahead. On that account, I would say the pharma sector for us looks okay. While the valuations there also have now run up, and it's not cheap as it used to be 1 year back. But maybe we are selectively looking at options. In US, I think they are also looking at the act on the biosimilars and all that. So maybe that also helps some of the CDMO players, which is also one of the areas which we are focusing on.
All right, Vineet, thank you very much. Good to have you on today and get all that perspective on the market. The market, by the way, is really surging now, 240 points up on the Nifty. It's a very good-looking screen. Apart from HDFC Life, there's practically no other Nifty stock that's down. And a couple of the auto names as well as IT, they're really surging. M&M is thumping a 3% up move right now. Tata Motors has revved up in the last couple of minutes to keep it good company. The auto index, there you go, is one of the best performing indices today. And then there are other tech names, Tech Mahindra, TCS, Wipro, all of them are getting some more sort of weight. And banks are in sync with tech. So tech and banks both firing, autos revved up. It's a real green looking morning.
Well, that's right. Good start to the trading session. But let's get focused on another management. Birla Corp. The stock has been under pressure of late. It hit a high of around 1,800 rupees, but it's seen a correction. In fact, in the last 1 month or so, the stock has lost close to around 17% of its market capitalization. To understand what's the way ahead post the weak showing in the first quarter, we have with us Mr. Aditya Sarogi, the CFO of the company. Hi, Mr. Sarogi. Good morning and always a pleasure talking to you. Thanks a lot for speaking to us here on CNBC-TV18. Well, the start to the year has been very subdued. Volumes are flattish. The EBITDA per ton has come in to around that 600 rupees per ton mark. What's the view for the remainder of the year? Earlier, you were talking about high single-digit growth in terms of volumes. And EBITDA per ton, you've always been guiding for around 850 to 900 rupees per ton. Post this weak start, what should we look forward to?
See, I'll give you a broad view. We are currently not making any revision to the guidance. So the broad view remains that Q2 will continue to be soft because of the seasonal effect of monsoon, and coupled with the fact that our ground check suggests that the government spend are not happening. But post Q2, we expect a meaningful recovery in the overall demand for the industry. And estimates and projections suggest that the industry should go at a rate of around 7% for the year as a whole. And we should not be different from the overall growth of the industry.
So 7% growth at the top line level for the full year, that's what you're saying. Can you, sir, also give us some sense of volumes as well? Overall, will this growth be more volume-led, or do you think that you will get some kind of a pricing lift once the monsoon period is over? And also just give us the immediate trends. Q2, what have you seen in pricing? Q1, what was the average realization?
Yeah. So in terms of growth, I meant volume only, growth in terms of volume.
Okay.
And in terms of the immediate term, because of seasonal effect, the monsoon effect, we are continue to see pricing pressure. And so far, we have seen about 2 to 3% drop in the realization. But post monsoon, beginning from somewhere September, October, we expect demand as well as the realization to pick up. And the costs continue to remain quite benign. So on cost front, all cement companies should continue to see healthy savings.
Okay, you gave us the volume target, sir. You expect to grow as much or more than the industry. So more than 7% is what we're noting down. EBITDA per ton, the lowest we've seen in multiple quarters. Where is it headed from here on? In quarter two, again, it will be under pressure because you're saying pricing is down, though you have some cost levers that you're looking at. So on an average for the year, what should it be?
At this juncture, Nigel, we are not able to provide any guidance, but by the end of next quarter, we'll have better visibility because it's primarily going to be a function of the volume and more importantly, the realizations. So how the realizations shape up post the monsoon. So at the end of second quarter, we'll be in a better position to give you some guidance on the EBITDA margin for the year as a whole.
All right, sir, you know, second quarter is unlikely to be much better than the first quarter because of it's a seasonally weak quarter. So assume you do 600, 650 rupees on a per ton basis. It'll be very difficult to give an average of 850 to 900 rupees because that would mean the second half of the year you have to do more than 1000 rupees per ton. So in all probability, for the year, you could end up closer to around 800 rupees per ton, even if you do 1000 rupees in the second half of the year.
I'll not get into specific numbers, Nigel, but let me give you a perspective. Even in the previous financial year, we began at around 650 rupees a ton. Our EBITDA per ton was not much different in the second quarter, but we made up in the third and the fourth quarter. So this year could be no different.
Okay, all right. So let's see how you recover then. Also tell us about Mukudban. What is the targets for this year? I want three numbers with regard to Mukudban. One is on volumes. If you could tell us what is the difference between your remainder of your business and Mukudban on an EBITDA per ton basis, and what is the incentive you're factoring in for this year?
We are on EBITDA basis, we are not disclosing the numbers separately for Mukudban, but in terms of volumes, we expect to be at around maybe 2.7, 2.8 million tons for Mukudban this year. In terms of incentives, in this year for the company as a whole, we have baked in about 110 crores for the company as a whole, and we stand by that guidance.
Okay. Sir, let's talk about what's happening in the sector overall, right? So much consolidation, the bigger getting bigger and bigger. How do you view this? And then just tell us your own plans as well. How much capex are you putting to work in this year and maybe next year? And will you think of inorganic moves? And how will this consolidation impact you in your key markets?
Oh, in terms of capex for this year, we have guided for 800 crores. We are standing by that guidance. And in terms of slightly medium-term perspective, we have guided for increase of 5 million tons to moving up to 25 million tons by 27. And we stand by that guidance also. In terms of effect of consolidation, we feel that in the medium to long term, it's going to be a very healthy trend because as the weaker players move out of the market, and the consolidation is always seen to have a positive impact on the industry.
Okay, so just reiterating the numbers, this year you're putting 8,000 crores to work. That's your capex for this year.
800.
Sorry, 800 crores. And in the medium term, you're adding 5 million tons.
Yeah.
Okay.
All right. Just to press on that other point, sir, about, the two giants lapping up companies left, right, center. So, and more and more as we see it, the consensus is becoming that, well, we're going to see a lot more of it. How does it change competitive dynamics for you?
In the short term, there may be some pressure, volume pressure, as they want to increase their market share. But in the medium to long term, we expect that a consolidation should be healthy only for the industry.
Yeah,
there will be more
don't
discipline.
You don't participate in the consolidation?
As of now, our focus is to grow organically. Maybe in the long term, definitely, why not? If we have a good opportunity.
Because I recall when we chatted once, you said $100 per ton is okay. And these deals are happening now. I mean, I wouldn't think India Cement happened at the price that it happened, or even Penna, given the dynamics. So don't you think if you're getting something at $100 per ton, and I know plenty of assets actually, Don't you think you're missing out? You would like to participate?
You're absolutely right, Nigel, but you have to look at the leverage position also. Our balance sheet leverage at current juncture does not give us that leverage or option to go for a major inorganic
Okay.
activity.
All right.
No,
What is the number, sir?
I think we were coming to you from a seller's perspective. Not to buy, but to sell, sir. Yeah.
Yeah. So seller, I would be, I have to weigh the assets more than the tangible assets. I have to weigh in what kind of assets I have. For example, what kind of mining mineral reserve, what kind of competitiveness I have in the market, what is my brand strength in the market. So it's a function of various parameters.
So what does that mean, sir?
Yeah.
So you're saying, I mean, has an approach been made? I mean, have you been approached? Have you been offers been made? Nothing.
So you said that your balance sheet strength currently doesn't allow you to look at a big inorganic push. Just tell us what is the debt level? What is the thought process? Are you looking to reduce debt? Are you comfortable? What is the gearing and whether you're comfortable with it?
See, our current net debt is 3,150 crores. We ended the year with a net debt to EBITDA slightly less than 2. So we are comfortable in terms of debt to EBITDA.
Okay.
But in absolute terms, the debt is not very low.
Okay.
So, and given our plans for organic expansion, we should not expect it to go down. So there will be repayment, but then we'll be raising fresh debt for the expansion.
Okay. All right. So very quickly, before we let you go, there was that Supreme Court verdict that came with regard to taxes being implied retrospectively if states go ahead and, ask for it. I understand that it shouldn't be that big an impact on cement companies, but the street still has a question mark. Your comment on that? For your company, is there any pending liability? And going ahead, do you think it'll be a big increase?
For our company, there could be some impact, but we have made full provision for whatever impact is there. So on our income statement, there's not going to be any material impact.
What is the amount?
Maybe we don't have the full calculation, but maybe around 9-10 crores or something of that sort. But we have made full provision, so there's not going to be any hit on the income statement.
Okay, Mr.
And for the sector as a whole,
Yeah, go ahead, sir. Finish that point.
For the sector as a whole, it will be a function of what kind of levies have been made by the state governments and what kind of stand has been taken by the individual companies. So if the company has gone for litigation, whether they have made full provision in the books or made any payments. So in case they have litigated the matter and not provided for in the books, only then there will be some impact.
Okay, Mr. Sarogi, appreciate you joining in. Thanks a lot. We're wishing you all the best for the remainder of this year. Things still looking like it's a bit of a flux, but you're sounding confident about the second half of the year. So we'll keep tracking that. Appreciate you joining in.
All right. Thank you very much, Mr. Sarogi. Let's move ahead. We have another company on the radar as well. eClerx reported numbers just a few days back. The first quarter was slightly muted for the company. The constant currency revenue growth came in a bit below street estimates. Margins were impacted in the first quarter due to wage hikes and senior level hires. We have with us Srinivasan Nadadhur, CFO of eClerx. Srinivasan, thank you so much for joining in. Let me start with the margin question first. So the way our team calculates margins is we don't look at other income and therefore the numbers. So your margin has dipped to around 17.2% in the first quarter versus about a level of 21%. And even if we go by, your company calculations, I think you're just below the range. You've guided for 24 to 28%. First quarter, you were at 23.3%. So just explain to us, is it only because of the hiring or are there any other sort of cost pressures? What about deal pricing as well? It's a wide range you've given, 24 to 28%. Usually companies give, like 150, 200 basis points. So what is the margin profile that you're looking at for the rest of the year?
Sure, ma'am. Thank you for having me on the call. To answer your question, the 400 bips drop in margin, whether we look at our calculation or yours, is largely because of two things. One is the wage hikes, which I would assume is somewhere between 60 to 70% of that overall drop. Another 20% because of business development hires and augmenting our sales capabilities. And the remaining is because of other items like electricity, rent, and so on and so forth. And that's why sort of our margin has come below the guided range of 24 to 28. But that is typically what happens in Q1 of every year. So even if you look at the same quarter last year, I think we had dropped maybe 506 bips according to our calculation. And we think that this we will be able to recover this over the next 3 quarters because of increases in revenue, because of replacement hiring, thanks to attrition, and therefore we will be able to come back within that range that we have guided for.
We are practically, halfway down the year. The second quarter is also practically coming to an end. So the visibility that you have now, do you think you will be closer to the upper end of that guidance or the lower? Because the wage impact will be made up, as you're saying. So then it's really all about business, the pricing that you're able to get, and the deal momentum.
Yeah, so at the moment, it would be safe to assume that we will be between somewhere around the middle. That's how I would look at it.
Middle of the range.
Yeah.
Got that. Srinivasan, hi, good morning. Prashant here. What about top line growth? Because I think we are at low single digits right now, right? Last
right.
time we spoke, you'd said that you'd aspire for double digit, you'd aspire for double digit growth. Could you give us would you like to reassess that? What should we expect? What should we pencil in?
Well, given the deals that we have signed in this quarter, there seems to be healthy momentum. Given the pipeline of deals that we have, which is also very healthy, we are going to stick with our original aspiration of double-digit growth. So we do think that things will improve from Q2 to Q4.
I mean, this is an aspiration, or this is you said aspiration, but you're confident you'll be able to do it?
We are reasonably confident. We are reasonably confident
25.
we'll be able to do it.
Okay.
Let's talk about double digits. So we are reasonably confident about hitting double digits.
Okay, so give us some more color on that, Srinivasan. Where do you see demand picking up in terms of verticals, in terms of geographies? What will get you to that double-digit revenue target this year? And is it going to be sustained? Because in the last couple of years also we were coming off COVID, etc. So the full year growth numbers have been very patchy, from very high levels to just dipping below the double-digit mark. So will this 10% plus be sustained? And some color on the geographies and the verticals that are firing up.
Sure. Of the three businesses, I would say our financial markets continues to show the most opportunities. So we are seeing a lot of deals thanks to regulatory pressures in our client geographies. So that's leading to a lot of work for us. Then in our customer operations, again, we see opportunities to improve in customer experience and chat, voice support. On the digital, it's a bit of a mixed bag. So we are seeing demand in some pockets in high tech, etc. But luxury and manufacturing continues to be a little bit of a, I would say, constraint. So that's the overall picture for our three businesses.
All right, Srinivasan, final question before we let you go. You're sitting on a good amount of cash, I think 1,000 crores odd. What's the utilization plans out here? Return some back to the shareholder, or is there some inorganic growth on the anvil?
Yeah, we just did a buyback in Q1. So I think that's not reflected in the Q4 cash position.
Okay, so it'll be relatively lower then, the cash in books.
That's correct.
All right, and no inorganic growth?
We are still looking, but nothing conclusive so far.
Okay, we'll wait by then for an announcement on that front. Thanks a lot, Srinivasan, for joining in and giving us all those details, how you see business shaping up. Well, time to slip into a short break, but on the other side, we'll get exclusive chat going. We'll have Rajat Rajkaria as well as Sachin Sane of Motilal Oswal Financial Services as their 20th Annual Global Investor Conference kickstarts from Monday. Stay tuned to that conversation.
Okay, welcome back. The market's given up some gains. Actually, not some, but quite a bit. About 100 points off the day's high for the Nifty. The Nifty is up 150 points. 24,300 is where we find ourselves at. Now, as promised, the Motilal Oswal 20th Annual Global Investor Conference kick-starts in Mumbai from Monday. To talk about this, as we always do, as we've always done, we have some of the top people with us here. Rajat Rajgaria is Managing Director and CEO at Institutional Equities at Motilal Oswal Financial Services. Sachin Sahani is Head of Sales, Institutional Equities at Motilal. Gentlemen, great to have both of you here in our studios. I think it's going to be manic next few days, as it always is, but also a lot of fun at the conference. 20th. So, I mean, it's a long journey that you've seen, and it's become like really a marquee event in the financial calendar, at least here in Mumbai. Very well attended as always. Rajat, tell us a little bit about what's happening this time around. How many companies? What's the size and strength looking like?
Yeah. No. Good morning. Thank you for having us here. It's sinking in that this is the 20th year of this conference. Started in 2005.
Yeah.
I remember that time we used to highlight the $1 billion club market cap. Today in the 20th year, we are talking about the $100 billion market cap, right? Yeah. We have been, I think, both fortunate and blessed that we are in this era of this country's capital market journey, where in the last 20 years of this market, we have been well associated with bringing some of the best platforms for our investors. So this conference, which has grown in size in the last 20 years, just to share some numbers, this year, and needless to say, every year is the larger than the previous year. We have about 200 plus top Indian corporates. We have about 1100 plus investors from everywhere in the globe to every corner of the country. And plus, this time we are doing a record 15,000 plus meetings for investors over a 3-day period, right? I think two important things that I can further highlight: the diversity of the participation of the companies is the best ever, right? And that's a way how the character of this market has evolved. And secondly, the same diversity we see in the investor base also. A decade back, conference used to hover more around, suppose, mutual funds and FPIs. Now you have mutual funds, FPIs, of course, they have grown in size, but then you have pension funds, insurance, family offices, HNIs, direct retail. I think this probably is at the most interesting point of the last 20-year journey that we have been hosting this
conference. You're talking about the $1 billion club. We had Ruchir Sharma with us. Shireen was talking to him on Friday. He said that over the last 2-3 years, India has seen the largest number of billionaires being created. I mean, the highest number. And of course, a lot of it is to do with stocks, assets, equity assets, which have grown in value and incredibly well. What's the theme this time, and what are you really sort of bringing to the table in terms of thought leadership? Because markets have done phenomenally well. I think the regular question always is, where are we in the cycle? And I think we'll get a lot of that. So let's just start with that.
Yeah. So, one very interesting theme that we are developing, if you look at globally or the investable 30-40 countries, right? You can divide half of them into size and half of them into growth. We probably are the most unique one where you have size into growth, right? Staring at 4 to 5 trillion and then growing at an annualized rate of 10 to 12%. We are rebuilding in the next 7 years what we have rebuilt in the last 78 years as a country. So I think the theme this year is that India is a destination where you have size and growth, point number one. Point number two, if you look at around the globe, you have events which are making things volatile, right? Whether it is east of us or west of us, right? Right from an US elections to the China slowdown to the Far East woes, right? I think we are again standing out as an investment destination, right? And the third thing is that till now we have always been talking about demand, right? And kudos that we have now almost 30 to 40,000 crore domestic pool coming into markets every month. But I think important is today when we stand, we see supply also building up into this market. So this market is going to be a lot more interesting going forward, because as much the demand for equities is going to grow, you're also going to see good quality supply also building up.
And that's great, right? Because that balance is so important to ensure that we don't get into some sort of a bubble where the supply-demand mismatch goes sort of beyond expectations. So actually on that, Rajat, and maybe Sachin come in here as well, because you have so many client conversations. It's a trend that has been firmly established that it is domestic investors, retail investors, institutional investors that are ruling this market. Foreigners have been consistent sellers throughout. What chatter do you pick up in those conversations? They all say they like India. What is the issue? Is it valuations? Is it better returns in the home market? And what would you be looking forward to in terms of all the FPI conversations that will happen in the conference this year?
Yeah, so good morning and thanks for inviting. I think the point which you well mentioned, so most of the FIIs and FPIs are thinking of valuations as one of the key concerns for Indian markets. Having said that, the interest which we are seeing from FPIs in the conference is also fairly large. And as Rajat just mentioned, it becomes bigger every year. So even FI interest in India is becoming bigger, and our conference is going to showcase that.
So they're not putting the money, but they're coming.
Yeah, exactly.
They're coming for sure.
So we'll ensure they will put money also.
No, but just focusing on this point, the FI ownership I think has come down to the lowest we've seen in the last 12 years or so. I think one of your notes as well mentioned that 18.5% odd. Are we getting to a phase where India is too good a market for them to avoid? They've been selling in, selling out is what we have seen. So your comment on that?
So I would just like to share one data point. Last quarter, China saw $15 billion of FPI outflows. That was June quarter versus India roughly $1 billion.
Yeah.
So I'm just saying that India definitely has the opportunity to get returns from the companies in India.
Yes.
So you have to see a relative.
So it's more an emerging market basket selling that we have seen, and that's why India is seeing a smaller part of that.
Absolutely. So
over the last many years, I think both of you would agree. It always used to be FI. The balance of power was always foreigners because they had the big guns and the big firepower. That has completely changed, and how? Right? I mean, last 3-4 years.
Every evening we used to go to bed seeing the net FI flows for the day, and every morning we used to wake up seeing how the US markets closed last night.
Yeah.
I think that phase has kind of been left behind
us.
Nowadays we see how much DI is bought every day.
Yeah.
Right.
And what domestic companies are doing.
Yeah.
So I think in fact, just to add, Surbhi, to your point, a lot of institutional clients call and ask as to what is retail and HNI and family office and PMSs are doing in the markets. So it's a very interesting time which we are in.
And to be sure, we're not gloating. Right?
We're just acknowledging a change in trend.
It is a fact. It's a change in trend, and it's completely changed. What can what can cause this 30-40 billion, 1,000 crores which is coming into the market every month, Rajat, as you said? What can anything shake it? A period of underperformance? Because as someone said, 8 out of 10 investors in the market now have come in the last 3-4 years. They've not seen a down cycle. And I think that's again something which you guys, I'm assuming, would talk about and discuss. And can anything shake this faith, your sense?
Look, I think first we need to understand why this is happening, right? It's a very natural phenomena of a per capita GDP growth that you see. When you were at $1,200, you were essentially meeting your basic demands. Today you are at $2,500. The pool of money that you can afford to spend is growing. And just a linear growth will take this 2,500 to maybe 3,500 in the next 4 to 5 years, right? So the discretionary pool is only going to grow. That is one. Second, equity, we can look at time periods, but at any point of time, you should assume that equity as an asset class post-tax can give you 12-13% return, right? The compounding impact of that comes with higher income level. So whether this 40,000 crores becomes 70 or whether it becomes 30, I think is less of relevance today. What is important is that in line with the GDP growth, if this number keeps growing, right, that's a large pool of capital over the next 5-10 years, right? And it's a you can say it's a compounding impact where the money is going into the market is growing that money, and that is pulling in more money into this, right? Only a period where you go through a very low economic growth, where your faith in the corporate earnings slows down, can slow down this, which we are not seeing at least for some time.
So very quickly, gentlemen, last question. Rajat, what are you most excited about in terms of the corporate conversations that we'll hear in the conference? Because the last year has also seen a trend in terms of a lot of new businesses have come to the market, and you mentioned that, right? New supply. Now, whether it's an Ola or it's a Nykaa or it's a Honasa, a lot of new companies are coming in. And investors are liking the whole turnaround journey as well. Zomato, I mean, we're waiting for Swiggy to come. So what is going to be the wow factor for you in terms of the corporates?
I think there are three very important questions that are being raised right now. Right. I think first, last 18 months, we saw manufacturing as a sector come back with a bang on the capital markets, right? We need to now see the next 3-year earnings progression for them to sustain where they are. Secondly, we saw consumer and discretionary actually slowing down in many categories last 18 months. And generally, investors would like to pick them at the first sign of a turnaround. Does this good monsoon and low rates in the coming future, right, help that? So that's again second question that people would want. And I think third, the most important is financials. Such a large sector in the market, not been performing well, deposit growth a challenge, right? Again, investors tend to pick the underperforming sectors at the first sign of a turnaround. At this stage of the market, while the markets have done well, you still have spaces which have underperformed. So I think people still want to make good money from a high of this market right now. That's what they are going to pick from the
Whether the underperformers can start turning around, and that's the next.
Yeah, and how much leg the performers have to continue to carry.
So the large private sector banks should be top of mind then. Some of them haven't done much in the last couple of years.
Absolutely, because they still constitute a large part of the earnings and the market cap both.
Indeed.
Okay.
Got that. I think we've been told to
wrap.
we have a lot
We've
more
been
questions.
instructed.
We'll see you all at the conference.
Thank you very much, both of you, for joining us,
Looking
Rajat
forward
and
to
Sachin. And we'll see you guys again on Monday and over the next couple of days as the conference comes on. So that conference, Motilal Oswal Marquee Conference, kicks off this Monday, 19th. And of course runs for the next few days. We'll take a quick commercial break here. We're going to come back. Mitesh is going to be with us with some technical trading ideas. The market was up 250. It's up 150 now. So there's a bit of give back, 24,300. Stay tuned. More coming up. All right, welcome back. 150 higher on the Nifty was more, as I said, about 100 off the highs. Mitesh is with us with what he'd want you to do now. Mitesh, good morning again. Thanks for joining in. What are your trades?
Yeah. Prashant, the buy on HCL Tech, and this is one stock, which is trying to break into all-time highs and open the gap up today and kind of cooled off a little bit with the market coming down, but not much. So the setup is still positive. Buy here with a stop at about 1629 and a target of around 1685 can be looked at. And the other one which I like is Dixon. It was a recommendation earlier in the week as well. Still looks good. So buy here with a stop at 12,080. Look for targets of 12,600.
Okay, all right, Mitesh, thank you very much for that. With that, I think we have to just take a break, leaving the markets with a gain of about 150 points. Midcap index is absolutely in sync with the Nifty, at least as of now, a gain of 0.6%. We take that break, and after the other side, it's time for our special segment. It's the economy. Lata today is connecting with a bunch of guests to discuss the rising demand for bonds and whether insurance companies invest some of their long-term funds in infra projects. Stay tuned for that.
Welcome to Genomics. One stark feature of India's bond market so far has been the huge borrowing by the government, which pushes up yields for corporates. This decades-old trend is about to change. For the first time, demand for bonds is rising because of an over 20% annual growth in insurance and pension fund kitties, as well as demand from foreign investors because of index inclusion, and banks who are faced with the LCR requirements. So the point is, can insurance companies therefore invest some of their longer-term funds in infrastructure projects? That's the debate we are having today, and joining me are two bond buyers, HDFC Life's Vibha Padalkar and SBI Life's Amit Jingran. And then we have an infra bond issuer, Rajkiran Rai, the Managing Director of NABFID, the National Bank for Financing Infrastructure and Development. Also joining me are two, you may call them moderators, former insurance regulator Nilesh Sathe and bankruptcy code expert Behram Vakil, partner at AZB. Gentlemen and Vibha, thank you very much indeed for your time. Well, you are the issuer and you want them to invest in infrastructure. Make the case, Mr. Rai.
Actually, if you really look at international scenario, that infrastructure is funded by bond markets and typically insurance and pension funds. And if you are looking at the foreign investment which is coming into the country also, these are typically the pension funds and the insurance funds abroad which are investing in India.
But they are not touching infrastructure in India, sir.
They are. Actually, if you look at InvIT and all the solar platforms.
InvIT, yes.
Because they are all infra assets. Actually, I'm not talking of the greenfield stage.
Okay.
It is only completed operating assets which are getting financed and refinanced, and they are the biggest investors there. Now, Indian insurance and pension funds have also evolved. Today, total assets and management under insurance, pension and PF, you put it together, it is 115 lakh crores. And it is more than 50% of the scheduled bank deposits today. And they are growing almost double the speed of bank deposits. So now where they will invest? Basically, typically 97% of the assets are G-Secs and AAA rated bonds. And now the yield there is going down. Somewhere the Indian insurers also have to look outside their typical investment, which is a very, very safe investment, because I understand their priority is safety, but somewhere they have to give returns also, reasonable returns with reasonable safety. Okay. So I think they need to get into this, because why we need to give these returns to the foreign investors when we have our own assets under management, which is substantially big. So why I say this is domestically, the kind of long-term resources is very much available in India. We used to look outside earlier. Now it is available in India. So much of it is more than bank deposits. Like every year, the incremental
money is
more than bank deposits.
The point is taken. Let me get Jingran and Vibha into the conversation. Mr. Jingran, will insurance continue to grow at this pace? I mean, the first 4 months is 35%. Will your kitty grow that well?
So the kind of Indian demographics and the kind of social changes that are happening, the insurance and pension money both are slated to grow in future at much more better place. So having said so, we are, as Mr. Rajkiran Rai quoted also, the growth will come from these two sectors, and the investment, of course, insurance being totally risk averse. That is one point we have to keep in mind. Wherever we invest, we have to be very sure that the money comes back. So IRDA has also permitted around minimum 15% of infrastructure funding, and insurance industry as a whole is 9% plus. So yes, the growth will come, and we will also invest as the world over trend is.
Of that 15% that IRDA has permitted, I think 9.5% only has been allocated. This is Mr. Rai's figures. So you all still have a headroom. You all are refusing to touch InvITs to the same extent, or infrastructure to the same extent.
No, we are not refusing to touch. I will say that we are investing, but the proper security in the market should also be there.
Fair point. That is the point both I think Mr. Rai and I are trying to make. The amount of securities that will be available to you, Vibha, is going to reduce because the number of people buying bonds has increased. Banks, because of their HQLA, the high quality liabilities that they have to park, Already 27% of deposits is going there. With the new LCR, liquidity cover ratio, 30 rupees of every 100 rupee deposit will go for bonds. That means an additional 3-4 lakh crore demand is coming. Foreign funds, because of index inclusion, are going to buy 25 billion worth of bonds. Some of it has come in. So your what is now yielding you 6.9 10-year bond will very soon be 6.75. Even then you will only chase bonds?
So let me just deconstruct your question. Yes, it is a fact that as fiscal prudence continues and government continues, and in all probability they will, the level of borrowings is also going to go down. So if you were to look at last year, given the where we were, it was about 15 trillion rupees of borrowing. Of the 15 trillion, from memory, about 50%, about 30 to 40% was above 15 years, which is what is attractive to Amit and me. Of that, 50% of the long tenured bonds are subscribed to by insurance companies.
Yes.
And that will just continue to grow. Now, to your point, yes, a scenario can come, whether it's 3 years, 4 years down the line, wherein our growth surpasses the
bank deposits.
And the
issuance.
The issuance of long-term bonds. Now, the only good thing is, as to your question as to will you continue to subscribe, to some extent, yes, because when we write an insurance policy, the rate is locked in. So the guarantee doesn't change. So if it is at 6.5% guarantee, then I'm searching for a bond at that time for me to have no ALM mismatch.
Yes.
Because insurance companies, first and foremost, have to, the golden rule is that you cannot have an ALM mismatch. We're not looking to, unlike maybe other financial
like
products, are looking to make that extra bit on, so that you have a yield pickup that you have. Yes, we do that on our own shareholder funds, but not on the policyholder funds. So safety becomes this because we are in fiduciary responsibility. So the way, the two can happen together has to be for some time a government backstop towards insurance companies, because ultimately these are, you and me and people out there whose long-term savings that we are custodians of, and we cannot absolutely miss a beat on that. That's what drives us.
Fair point. Mr. Sathe, this is where you come in, sir. If I, as a person who will eventually be drawing pension, I'm asked, I don't want my pension to go into an infra project which perhaps may not take off, which may perhaps become a bad loan. So I want my pension money. But at the same time, you want the country's infrastructure to benefit from this long-term money. As a regulator, or the former regulator, how will you be able to marry both? And ensure security, but at the same time, a growing pool. How will you marry it to the infrastructure needs of the country?
The first is the 15% limit which is prescribed is yet not followed by many insurance companies. So there is still scope for investment in infra. This is one point. Second is, as Vibha said, insurance companies are more onto safety. So although 50% of their investable fund has to go to government securities, most of them, public sector and private sector both, insurance companies have more than 65 to 69% of their investable funds under government securities. This is second part. And the third is, now IFRS is around the corner. And in that, mark-to-market losses will have to be taken into account.
Okay.
Now, everybody is worried about this because this is going to have a dent on the balance sheets of many insurance companies. So they probably may not venture into any sort of new investment avenues unless IFRS stabilizes. This is what is my view.
Okay. Let me get Behram also into the picture, because in a way, Behram, I hold IBC the culprit. We had a hope that if IBC worked very well, then people, people who are custodians of pension funds will be willing to invest in infra. But IBC has not lived up to the promise. It's taking forever to resolve bad loans, and recovery is like next to nothing. It is almost bankruptcy value that you're getting for recoveries, except in perhaps two steel companies. So do you think there is any hope that the bankruptcy law will become a little better? Or at least a carve-out can be given to insurance investors?
No, so I think, thanks a lot, Lata. Of course, I'm biased, as you know, but I think it's a bit unfair to say that IBC has not done well. I think if you break it up into pre-COVID, the first 3 years, the recovery was about 44%. You know all these stats. It was double before, and it was about 18 months, even though billions of dollars of cases, and which was the fastest in the world. After that, no doubt there's been a slippage and things have slowed down. But we are hoping that there will be a bunch of amendments which will increase the speed and the efficiency sooner than later. Sometime this year is what the government says. So I think that should be very good for the system.
Can you just detail a little what kind of, you're expecting laws that will speed up cases? Will there also be laws that will increase the recovery for the lenders?
It's a direct correlation between time taken and the recovery.
Sure.
So if in the old days, as I say, the first 12 cases, we got close to 50%. And even if you look at the three, of course, those were financial institutions, Divan, Shrey, RCAP, etc. It took about 18 months, and I think it's not a bad recovery.
Yeah.
But I don't want to keep defending IBC, so I get your point. I think on the flip side, what all the other panelists have said, that we need the money desperately. We all know that, $5 trillion economy needs $4.5 trillion of infra. And we have these deep pools of capital. It's growing fast, but it will have to be credit enhanced.
Okay.
So whether you do it like NARCL, our bad bank, where there's a government backstop, or you do a FLDG, you create some product where at least in the beginning, because as all of us have been saying, as a pension or insurance, you are fiduciary.
Yes.
So your safety has to come first.
Okay.
Again, we know all these models, like don't do any greenfield, do brownfield. With roads, you construction, toll rails, sab kuch ho gaya, and then you do it.
Yeah.
So, and then as the comfort comes, as the comfort comes, then you will reduce the backstop. And if it's good for CPPIB, why is it not good for our own insurance company?
Story so far, we are heading into a time when the issuance of government bonds is going to be less than the number of people who want to invest in government bonds. So will they put that long-term money in infra? As Behram says, perhaps the way out will be to have some credit enhancement, somebody guaranteeing the first loss from infrastructure projects. Well, those questions to my panel after the break. For Bazaar viewers, you will have Chartbusters, but you can get to hear the entire discussion after market hours.
Ola Electric zooms more than 10% as it releases its Roadster range of electric motorcycles. Brokerage's HSBC issues a buy rating even as net loss widens in the first quarter. Hindustan Zinc falls over 7% as promoter Vedanta increases the size of its offer for sale to 13.37 crore shares compared to 11 crore shares earlier. Electronic Mart shares rally but cool off from the highs of the day after a big block deal which sees over 8% equity worth 712 crore rupees change hands at 232 rupees a share. Aurobindo Pharma comes under pressure as the company receives a warning letter from the US FDA for its UGA Unit 3. And the Nifty IT index continues to be the top sectoral gainer, rallies for the fifth day in a row following cues from the tech-heavy Nasdaq's recovery as recession fears ease in the United States.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me today is Hormuz. Well, Hormuz, it's that sort of a day yet again. The overnight Q was pretty good. We opened up gap up, but we were unable to sustain at higher levels. And early this morning, it pointed out that around the 24,350 to around 24,400, that could be a level where we could see some supply. And Pat, from those highs of the day as well, we have come off a little bit. The breadth of the market is still in favor of the number of stocks advancing. But I think, that buy the dip is going to be tested in today's trading session because we've got that dip. Let's see whether or not we can bounce off from here.
It's been the story for almost the last week or 10 days, right? The Nifty has struggled to cross that mark of 24,350. And you could see, pull up the chart that shows the fall from the highs of the day. That's the chart we are looking for. And it's been a struggle for the Nifty. We're getting to 24,350, but we have not been able to cross that. Even Wednesday was a range-bound trading session. We only managed to get to 24,200 then. And for the week, we still remain lower. 24,367 is the level that we need to focus on for the Nifty to end positive for the week. And if that does not happen, the Nifty will fall for 3 weeks in a row. And the last time that happened was between July and August of last year. So it shows the kind of market that we've been in. But so far, it's been that story. The highs just not able to sustain.
All right. Well, let's focus on a stock then. Sarda Energy and Minerals. Well, that stock has been on fire in the last few days. Now, the company's resolution plan to acquire SKS Power, well, they have got the green signal from the NCLT. To understand more on this as well as the way ahead, we're joined by Mr. Kamal Sarda, who is the Managing Director